In a custom workshop, tracking costs is a straightforward exercise. If you are machining a bespoke part on a metal lathe, you can pinpoint exactly how many hours of labor and how much raw steel went into that specific order. This is job order costing. In contrast, a massive petroleum refinery operates with a continuous, unsegmented architecture. Millions of identical gallons of product move ceaselessly through a labyrinth of pipes, never stopping for individual segmentation. You see this same reality in textile manufacturing. Infinite rows of bobbins wind identical white thread 24 hours a day. This also applies to the assembly line, where thousands of identical computer monitors move through the facility as a single homogeneous stream of production. In these environments, the traditional accounting model breaks down. It is physically impossible and economically absurd to assign exact pennies of labor or overhead to a single inch of thread or one specific drop of refined oil. To solve this, accountants use process costing. Instead of trying to track individual items, this system takes the total costs of production and averages them out over a specific time frame, assigning those averages to the goods produced. Under process costing, you stop looking at individual projects altogether. Instead, you accumulate your costs by department. To accurately report the finances of a mass manufacturer, the accounting architecture has to perfectly mirror the sequential, continuous flow of the physical factory line. This flowchart maps out that financial architecture using T accounts. In this ledger system, inventory accounts are increased by transactions on the left side and decreased by transactions on the right side. Step 1 for all processes is obtaining the physical inputs from suppliers. This entire left column represents our starting pool of available resources. Notice how direct materials are tracked separately at the very beginning of the tracking process. The rest of the operational inputs, wages, manufacturing overhead, property taxes, insurance, and depreciation, are all aggregated. We group these into a single functional category, known as conversion costs. These resources are then fed into the first stage on the factory floor, represented here by the work-in-process account for Department A. Step 2 requires that the actual direct materials used by this specific department are added to the left side of its T account, increasing its balance. For Step 3, the aggregated conversion costs consumed by this first department are added directly beneath those materials in the same account. Department A's T account now holds the total actual costs incurred during the very first phase of manufacturing. Because the physical product moves down the assembly line, the accumulated financial costs have to move right alongside it. In Step 4, the total costs exit Department A on the right side and drop down to become the baseline starting costs entering Department B. Department B adds its own layer of processing to the units, which requires pulling further direct materials and conversion costs from the main input column. The ledger is strictly cumulative. Department B now holds all of Department A's transferred costs, plus its own newly added costs. When processing is completely finished in this final department, all of those accumulated costs are transferred out to the finished goods account. This finished goods account represents the total averaged cost of complete, sellable inventory currently waiting in the warehouse. The final financial trigger occurs when a customer purchases the product. The costs are then transferred out of finished goods and into cost of goods sold. This sequential structure allows massive operations to take millions of scattered input costs and cleanly funnel them into a single, accurate figure on the income statement. There is a major complication in this system we just built. This flow assumes every unit that starts production finishes in the exact same reporting period. Imagine the financial books closing at midnight on December 31st. The continuous factory line stops for the reporting cutoff, leaving thousands of units sitting half-finished on the belt. Looking back at the flowchart, this physical reality is captured exactly here at the double-underlined ending work-in-process line in our T account. You cannot assign the full cost of a completed unit to a product that is only 50% finished. To restate this unfinished inventory accurately, accountants use a specific mathematical solution, equivalent units of production, or EUP. EUP calculates the exact number of fully complete units that could have been produced using the actual inputs consumed by the incomplete units. By taking the total costs and dividing them by these equivalent units, departments can determine a highly accurate cost per unit for the period. That cost per EUP rate is then multiplied against the remaining inventory, establishing a concrete dollar value for the ending work in process line. Without calculating EUP, process costing would fail at every month end. It is the mathematical bridge that allows continuous physical manufacturing to be cleanly divided into discrete financial periods.